Hello and welcome to the Private Capital Podcast. I'm Joe Riley, head of Circulus Group, which is a forum for the family office world. Jason Schwarz is Deputy Chief Executive Officer and President at Wilshire, which currently manages over $100 billion in assets and advises on $1.3 trillion. Jason was raised in a legal family, but his path diverged from the expected, fueled by a desire to carve his own niche. He told me, "I think you see this with sons and daughters of successful parents. One path is to follow in the same direction. The other is to go in one's own direction, and I chose that." This decision led him westward, where he immersed himself in the ever-evolving realm of investments, including an interesting side trip to Hanoi. We talk about what makes an effective consultant, the burgeoning OCIO business, what he learned from legendary founder Dennis Tito, and the transformation that Wilshire underwent following its acquisition by Motive and CC Partners, where Schwarz played a pivotal role in streamlining previously siloed divisions. Jason joined Wilshire in 2005 and has held a number of increasingly senior roles within the firm, including establishing Wilshire as a leading provider of investment solutions for financial intermediaries, advisors, and their clients, and ultimately overseeing all of the firm's business segments. Jason holds a BA in government from Hamilton College and an MBA from the Marshall School of Business. Please enjoy my conversation with Jason Schwarz.
This podcast is for educational and entertainment purposes only. Anything said by the guests or host should not be construed as legal or investment advice. Thanks for listening.
So I'm always curious as to people's backgrounds. I'm wondering how I'm not talking to Jason Schwarz, attorney at law right now.
My father was an attorney, and I think I was a successful attorney. I was an early lawyer at Skadden Arps, and I think was eager to chart my own path. And I think you see this with sons and daughters of successful parents. There's a couple different paths, one of which is to follow in the same direction. The other is to go in one's own direction. And I chose that and chose to move out west and pursue a career in the investment industry.
Had you always been interested in finance?
Yeah, I think I was interested. I had some exposure at a relatively young age and did some internships. Liked to read the business section of the newspaper, like to talk about investment ideas. I think I appreciated at a young age the really dynamic nature of the business, but the business is a big business, right? And so many different things. And I think I was taken by the really dynamic and ever-changing part of it. But I wasn't clear to me whether I wanted to be an investor, whether I had a facility with numbers. I wasn't sure that sort of being an investment professional was the path. And ultimately, I found myself really as a broader kind of executive sitting within an investment business, but that wasn't entirely clear to me at a young age.
Any early influences like Peter Lynch or Buffett?
No, I was more focused on, I think, people that build great businesses. I got started, I would say, in a time when the stock market was becoming more and more accessible. The first time that I really started investing, small amount of money, was in the kind of mid 90s when everything was going straight up, and learned a lot of valuable lessons about not chasing hot dots and getting caught up in the sort of latest fad, which clearly was internet related, go technology stocks in the mid late 90s. And while I read Buffett and I read and was familiar with Peter Lynch and a lot of the great titans of the industry at the time, it was a fascinating time to come into the market, and a lot of humbling lessons were lurking around the corner.
Can you tell us about the time that you worked in Hanoi and what you learned there?
It's a great opportunity when you can start as a young person your career in a third world communist country. So I went over there actually for an internship in the 96, 97. So it was a really interesting time. The U.S. had not quite normalized trade relations with Vietnam. That happened in 1997. And so it was it was still a very much a third world country that was developing pretty quickly. It was quickly becoming one of the kind of newest Asian growth stories. but the U.S. couldn't do business officially in Vietnam yet. And I was 20 years old and didn't really know anything. But what I did learn was the importance of relationships. This was from a cultural standpoint, big banquet dinners and much longer of a courting process. And I worked for a firm that was helping U.S. businesses pre-position themselves for the time that the Vietnamese economy and market opened up to American businesses, which certainly happened. And so, yeah, it was a remarkable place to start and listen and learn and observe and see how people interact with one another and also see the early green shoots of a more liberal economy and what capitalism does. I'll tell you, Joe, the most amazing thing was out of the legacy of the Vietnam War, born in 1974. And one of the first questions that I would be asked is, when were you born? And 1974 was also when bombs were being dropped on Hanoi. And the young people wanted to talk about American culture and American music and American clothing. And the cultural connections, I realized at that point, there were so many more similarities than there were differences. And that alone was a remarkable kind of takeaway that certainly I've taken with me. Didn't realize it at the time, of course, but it was a pretty cool early experience.
Do you ever want to go back?
Yeah, very much. I have 3 children now, and I tell some of those stories to my kids, and I have not been back. It's been a long time, but I absolutely want to go back, and I don't even know if I'd recognize it. There's been so much change, but very much want to do that.
Does Wilshire advise on funds in Vietnam?
We still, for the most part, serve a principally U.S. client base for whom Vietnam allocations or investments would be a really small amount. But I've watched and observed the development of a stock market, and that's obviously a precursor. It is a maturing opportunity zone, but not one that we're particularly active. We do quite a bit in Asia, but it's likely just a matter of time.
I understand you worked with one of my previous guests, Alex Chaloff.
It's a great story, Joe. It also is one of these, we often hear that the sort of financial services is a pretty small community. And I'll tell you the story. I had the great fortune of joining Wilshire in July of 2005. And the guy that hired me, a former MBA graduate from USC, where I had recently graduated from. And so I was hired into Wilshire to join a new division, which was going to be focused on financial intermediaries and taking the firm's kind of institutional platform and translating that for insurance companies, banks, and broker-dealers. And the gentleman that hired me was a guy named Alex Chaloff. And so Alex hired me and then went to Bernstein like 3 weeks later. And I only spent 3 weeks at Wilshire with Alex. I give Alex great credit for bringing me and then, frankly, just turning me loose into the deep end of the pool to try to figure things out, which thankfully was able to do. But yeah, that's the reason that I'm at Wilshire. And lots of credit to Alex. And he's still in LA and he's had a great career at Bernstein. Our firms obviously continue to be close, but I thought you'd get a kick out of that story.
So let's dive in. What is the breadth of Wilshire today?
So we do a lot of different things. We are one of the largest investment advisors, investment consultants to pension funds, foundations, and endowments. We offer a broad array of financial advisory services, whether to asset owners, institutional investors, or to individual investors through relationships that we have with financial institutions. So we manage pools of capital on a non-discretionary basis. We manage pools of capital on a discretionary basis where clients tell us, hey, you do it for us. We manage a whole lot of multi-asset class based solutions. So we are a manager across asset classes using investment managers to deliver kind of investment outcomes. We oversee about $1.3 trillion in assets. So those are advisory assets. And we manage about $100 billion in assets. And we are increasingly on the retail side of the business as well as the institutional side. And we are also a large provider of alternative investment solutions. So pretty big span. I would say the connective tissue is we are really focused on helping investors improve their investment outcomes, helping millions of Americans and others retire with dignity. And in that respect, we have hundreds of thousands of individual accounts and millions of Americans that are beneficiaries of funds or pools of capital that we advise on.
How should we think about Wilshire in its current version as a business? It's hard to find a direct comp.
Yeah. So I think we have parts of our business that look like a lot of different types of firms. There's a cohort of large, successful, well-credentialed investment consulting firms. So we have a part of our business that looks like an Aon or a Russell or a Callan. We have a part of our business that looks more like a private markets asset manager and advisory platform, perhaps akin to a Stepstone or Hamilton Lane. And we have a whole lot of our business technology-enabled investment solutions designed to help, the individual investor market and, principally through defined contribution plans that looks more like what Morningstar does in the managed account space. And frankly, we also have a lot of our legacy is attached to risk analytics, things that look like FactSet or Barra, as well as indexes, right? Where there's a whole host of index providers. It continues to be an incredibly dynamic firm. But again, there is a connective tissue that really connects the various pieces to high quality investment advice and improving individual outcomes, whether it's we're providing the tools for investors to do it themselves, whether we're providing investment advice, or whether we're providing outsourced discretionary management of that capital. It all allows for a flexible delivery, but all connected around the core concept of investment advice.
Do you benchmark yourselves against the industry, or do you lean more on internal benchmarks?
I'd say we're conscious of other great firms in our industry. We are more focused on internal benchmarks and have pretty grand ambitions of where we want to take the business, which ultimately for us matter more.
Maybe we could jump into the really interesting recent history and talk about the major changes at Wilshire since the acquisition by Motive and CC Partners. We talked offline about the move to combine and streamline the businesses. And I'd be fascinated to hear about how those discussions developed initially and evolved over the execution over these last few years.
Sure. As we've talked about, and I think I ran the business for our founder for many years, and Wilshire was up until 2021 still majority owned by our founder, Dennis Tito, who was a legendary figure in the industry, but also had very particular ways in which he wanted to organize the firm. And while I was able to bring about a degree of modernization and change, right, and evolution, there were certain limiting factors. And one of those was Wilshire was organized in 4 different divisions or business units, consistent with the kind of span of the business that I shared a moment ago. We had an analytics business, risk analytics and risk tools. We had a consulting business. We had a funds management business where we managed assets for intermediaries. And then we had a private markets business. And each of these were individually organized businesses with their own P&L. And in many respects, it was a franchise culture where there was a centralized legal compliance, finance, accounting, et cetera, and some basic control functions. But each of these were individually organized to pursue opportunities. And while that worked to a degree, there was certainly a lot of the kind of innovation and a high degree of entrepreneurial kind of ownership, speed to market. There was a number of different benefits, I think, that came with that over time. If one observes lines between so many different kind of components of the industry have been blurring, the lines between institutional and retail, the lines between traditional investments and alternate investments, all of these were blurring, and increasingly we had areas of the business kind of bumping into each other. There were inefficiencies. We weren't necessarily speaking with one voice. And so the first thing that I did when we brought in new partners, they really bought into this vision of a one Wilshire. And the idea behind this, and a lot of companies struggle with this, is how do we create really a unified business and move from a vertical divisional orientation to more of a functional framework. And so we really let loose this sort of one Wilshire. We built a single client-centric investment platform. We have the ability to take all of the firm's capabilities and deliver it to clients in the best fit, whether it's an institutional client or a retail client. And effectively consolidating teams into a cohesive unit, we were able to create a number of efficiencies and deliver, I think, much more tangible benefits to our clients. And this was probably the first thing that we did post-acquisition. And frankly, to the credit of our new partners, this was like, go and go faster, right? This makes all the sense in the world, go do it. And so that was one of the first things we did.
How did you think about the different cultures at these divisions and how to weave them all together? I'm sure they're very different from each other, the analytics versus the consulting and the money management.
A lot of this is the work that leaders have to do on the line to get people together, to buy into a common vision, and really to coalesce around what is the driving force behind organizational change. And for us, it has to start and stop with the client. And the more that we're focused on the needs of the client and how do we get closer to our clients, how do we be better partners to our client, then a lot of these answers and the right outcome becomes a lot easier to get to. And our investment teams were working together already. We were able to create kind of investment committees, if you will, that pulled folks from across the organization. And so we were elevating people to different roles, I think pretty thoughtful in how we created those new leadership teams. And we were really relentlessly and ruthlessly focused on doing this for the right reasons and doing this for able to deliver greater capabilities. We were, in many respects, our clients didn't fully understand and appreciate that we had all of the capabilities that we did. And so I think the other piece, Joe, was being able to get some quick wins and demonstrate early on that this was the right direction. And we started to do that when clients started asking us to do more. And so we got more opportunities to be better partners, to serve our clients in different ways. And a lot of that was just by being able to explain the full breadth of our capabilities, because now we had teams that were pulled from different parts of the organization, that were no longer focused on a particular silo.
You folks recently acquired Elixir, a $20 billion asset manager, which I think was the first acquisition that Wilshire's ever made. How are you thinking about acquisitions to drive value for the business?
That's without question, that's the other major driver of value creation for us over time. We continue to excel in the things that we do, manage more assets, develop and deliver more solutions into the wealth and alternative space. Like those are things that we're intently focused on. But for 50 years, Wilshire had neither bought nor sold anything, and are thinking about M&A as an opportunity to increase the capabilities that we have, where we can offer more of a deeper solution set to our clients. We have world-class clients. We have an amazing roster of clients across both the institutional and intermediary segments. And so our ability to pull in additional content, which we may not all have in-house today, is a big driver. We're also thinking about ways to expand and grow geographically, where moving into new markets may also benefit from. And our first acquisition was consummated in December and off to a great start.
So what do you think of as Wilshire's key competitive advantages?
I think it's our history of innovation. From day one, we've always, I think, really creatively extended our capabilities in our client set based on market need. We pride ourselves in being our clients' first call to solve some of the most complex problems. We were one of the first firms with analytics, with investment analytics, risk analytics, and literally some of the first with kind of software and index solutions. We were there at the early days when the pension consulting industry was just getting started. We were early movers in alternatives. We got into the intermediary space decades before many other firms did. And as we always have, innovation has been a really important kind of central part of, I think, what makes Wilshire special. And whether it's democratizing access to alternatives or creating new, more personalized retirement solutions, pivoting towards different types of digital solutions. All of it, of course, has been underpinned by really strong investment backbone across asset allocation and manager research. But it's a firm that's never been stagnant. We're in our sixth decade now, and we're not doing the same thing that we were doing 20 years ago. And that's not always true, right? That's not always the case in this industry, being flexible and nimble. So those are some of, I think, what makes Wilshire special and unique, Joe.
Be great to hear your overall market analysis as an insider of the consulting field, which I know has become increasingly challenging.
There's no new pension funds being created. And so the very nature of the business creates a competitive dynamic where they are competing on price. Firms are clients, frankly, every 3, 4, 5 years. It's a part of the market that tends to rebid services with some degree of frequency. And that alone creates a challenge in the pension consulting arena, where, frankly, you're seeing a number of firms, I think, also move into other areas of the business. We started doing that 20 years ago. And so the consulting business is incredibly important. It's an amazing halo. It's a great source of credibility and thought leadership. We take our role as fiduciary incredibly seriously. And it's a great way for us to see thousands of investment managers and to sit in the room with some of the greatest investors in the industry and really have a hand in charting the various kind of asset allocation challenges and asset liability realities that many of these fund sponsors have. But it is a tough business, and it is a business that continues to evolve. And as a result, organizations in that space need to evolve as well.
What do you think of as Wilshire's key competitive advantages in the consulting market?
So I think the firm's kind of heritage in the risk space continues to really be an important differentiator in the way that we think about creating portfolios and managing different asset allocation solutions. As a firm that has long believed that the essence of investment management really is the management of risk. And frankly, as an inventor of many of the early risk tools, equity and fixed income risk models, the first asset liability model for pensions, that risk technology continues to be an important differentiator. I think beyond that, we have great consultants. We have great manager research professionals. We have an amazing ability to move from asset class space to manager space and working with our clients. We, I think, are flexible and easy to work with and highly responsive. At the end of the day, being an organization that our clients want to work with. The average tenure of our relationships is 15 years. We have longstanding relationships, and I think we have a wonderful reputation in that consulting space.
When you're advising and looking at that universe of managers, is the value in the big stars that we all know, or is the true value in the smaller managers?
It's a great question. Look, I think that there's a body of empirical data that suggests that next great manager is not necessarily the current great manager. And while we allocate to large managers, we allocate to household names. There's some great managers that are very large. There's also a powerful data set that supports this notion that small and mid-sized managers that are hungry, that are in that smaller mid-market space, in whatever their sort of asset class is, whatever their sort of specific style is where the future alpha often sits. And so we spend ample amounts of time on kind of both sides of the market. Look, underneath all of this is a belief that essentially active management is a zero-sum game. Those that are winning are taking from those that are losing. And so you really have to be able to identify the basis of the competition upon which managers are competing in the marketplace for alpha. And that's really what this comes down to, and why so many firms like Wilshire spend a lot of time on manager research and seeing thousands of managers and really believing that the pattern recognition that comes from seeing so many managers and really managers that have a particular style of investing, you really have to look at those managers together. And ultimately, you really get a sense of both understanding the basis of the competition as well as which managers are positioned to be the takers of alpha in that game.
Now, what about the opportunities that you're seeing in the OCIO world, and how's that business coming along?
So I think one of the more persistent trends is that asset owners with $1 billion or less are increasingly looking to outsource to OCIO firms. We think that continues. Wilshire is an active participant and a player in that space. And I think that's one of the big sort of lines of demarcation. It seems like about $1 billion or so where fund sponsors really question the extent to which they want to have the resources in-house. Look, it's harder to be nimble. It's harder when you have monthly, quarterly investment process committees and all of that to be responsive to market realities. And so smaller organizations are increasingly looking to those outsourced platforms. And we like that business. It's just a different expression of a consulting engagement. We can provide that as non-discretionary advice, or we can express it and provide it as discretionary management, where it provides obviously a degree of scale and infrastructure that we have that we can extend to our clients.
Do you find the consulting arm is helpful in that regard?
Yeah, in fact, most of our OCIO clients started out as advisory clients. And so at some point, there's a natural transition and a relationship that extends. We think of it as co-CIO, not always OCIO, because OCIO often has this connotation that we're replacing a team or a staff. Co-CIO is really an extension of staff and a partnership. And so that's the approach that we've taken with many of our existing clients that seek to extend the engagement in that direction.
Maybe we could talk about tech and analytics. I'm interested in if Wilshire is mostly building in-house or are they actually actively out acquiring?
So we have analytics in-house. We actually, April of 2024, last month, Joe, we announced the sale actually of Wilshire's risk and performance analytics solutions to Clearwater Analytics Holdings, which has created the Clearwater Wilshire Analytics platform. And we have a number of third-party tools. We are still the largest users today of what is now known as the Clearwater Wilshire Analytics platform. And this is a part of the platform that dates back to Wilshire's first couple of decades, which I alluded to earlier. So we're still users of that. And that is really powerful kind of equity and fixed income risk analytics and multi-asset solutions. And those are tools that we use to evaluate managers and portfolios and really separate skill from luck, if you will, and be able to look at active return and active risk in all sorts of different ways. And so we use those tools. We use other third-party tools as well. And so it's a combination, and we're constantly developing and building. And that's something that Wilshire continues to be a place where that degree of kind of innovation on the desk, where our investment teams are looking to solve problems for themselves as practitioners. And that's in many respects how a lot of the analytics that we built have started, because of the advanced work that we need to do. And that's still our operating model internally.
So I just interviewed Michael Wise from Yield Street. That might be a good way to talk about how you folks are thinking about alts and your clients.
Yeah, and we have a partnership with Yield Street. And like Michael, I'm a big believer and advocate in the democratization of alternatives and bringing broader access, broader insights to parts of the market that have not historically had such access. And in fact, Wilshire's business today is large part of our platform is delivering the institutional quality investment advice into solutions designed for the individual investor market. And say the majority of our discretionary assets sits in that vein. We're the third largest provider of model portfolios, second to Capital Group. I believe BlackRock is number one. And so we're really in good company there. But following the comment earlier about broader trends, are incredibly excited about what is happening in both the private market space and the liquid alternative space broadly, where if you think about there's 33 million American households that have assets between $500,000 and $5 million. If you think about mass affluent and single digit millionaires. And the average allocation to alternatives from that segment is like 1 or 2%. And it's a huge opportunity to provide meaningful, high quality alternative solutions to that subset. But what are they going to need to consume? And our belief is curated, packaged, risk managed portfolios that can take the great managers that we look at, can take co-investments and other opportunities that come out of the due diligence process that we have in place, but build third-party, open architecture, best-in-class solutions is a huge opportunity for my organization and one that we're incredibly excited about. And what Michael's built at Yield Street is an example, a phenomenal way of connecting content to investors. It's one of the, I think, great pockets of new opportunity in our industry.
So BlackRock used to be a bond shop. Blackstone was a PE fund, and now they've broadened their reach to serve many clients, including retail. Does Wilshire evolve along the same lines, become like an asset management omnibus? What does Wilshire look like in 5 to 10 years?
I think we'll have far greater business across the wealth and retirement spaces. I think we'll be one of the dominant providers of our alternative solutions to the retail market as well. We'll look more like an asset manager in that respect. Difference is that we don't buy and sell securities, right? We use managers and other co-investment secondaries when we're talking about private markets. So I think we will continue to look more like an asset manager in the way in which we deliver content. We'll do it a little bit differently, and we will have a dominant position in the wealth space, the defined contribution space, and across both hedge and private markets.
I'm curious how you structure the way you think about the challenge of serving so many different types of clients and how to serve them best. How do you coordinate that across the firm?
We think about it as having kind of one content engine. And so the content engine is having the best asset allocation technology and frameworks and the ability to create the right asset allocation starting point for whether it's a pension fund client or a broker-dealer client, a family office client, or an RIA. So there's lots of different kind of flavors of asset allocation, and the asset allocation decision really is driven by the unique investment objectives of a particular client. And so it starts there. And then we have a manager research platform that is evaluating managers, equity managers, fixed income managers, funds, all sorts of private equity, private credit, private real assets, a unified and centralized manager research platform, which is essentially, those are the securities, if you will, that we put into portfolios. So as we move from kind of asset class orientation to manager implementation, we have this really powerful engine. And then the way that we deliver the actual content is a function of the unique needs of different types of client cohorts. And that's where the portfolio construction decision sits. And so we have portfolio managers that maybe work with a family office or an RIA client. And we have portfolio managers, investment consultants that work with public and corporate pension funds, foundations, and endowments. And so if you think about the way we have organized the firm is one manufacturing line, essentially, with different ways to deliver the manufactured content. And it really becomes an assembly exercise. And that is highly customized to the ultimate client end user.
I'm curious how you structure the relationship to use the firm's resources most efficiently. I'm sure some of these clients are somewhat demanding.
Yeah, sure. All, I think, firms are challenged by clients that have differential demands. There are certain parts of a business that can be scaled, and technology is a big answer for us in how we deliver content, this sort of moving from paper to portal, right? So the digitization of delivery of everything from reports and deliverables, the stuff that was principally paper 10, 15, 20 years ago is increasingly digitized. And so that allows us to work with different types of clients in different ways. We provide investment advice to over 75,000 plan sponsors, small plan sponsors, right? So plan sponsors with an average of $2 million in plan assets. And so one of the biggest parts of our business is not just providing advice to very large $100 billion pension funds, but also to overseeing as a fiduciary investment advisor assets for like startup businesses. And the only way we can do that is through technology and the ability to not just deliver reports and deliverables via technology, but also to render portfolios increasingly using technology for different types of clients. So that's a big part of how we think about the ability to serve different clients in segments that we still think are attractive. But the answer has to be using technology and humans in an intelligent way.
How do you folks think about talent? How do you compete for tech talent and invest talent versus folks going to some place like Google or Citadel or a fintech startup?
So this is any executive, one of the arguably most important role is how do you attract and retain talent? investment talent, technology talent, client-facing talent, all of that. It is arguably the most important thing that I do. And for us, the answer is we have this amazing brand. We have this amazing sort of history, 52 years, but it feels like a startup and it's dynamic and entrepreneurial. We're a small company and this amazing reach and a brand that's known around the world. And so what does that mean? Keeping that sort of spirit alive of where great ideas can quickly materialize, where young people can contribute in really substantial ways. Look, there's a lot of amazing firms and we both hire from those firms and have contributed people to those firms. But the ability that people have at a firm like Wilshire to emerge, to grow more quickly, to get the type of kind of learning currency that comes from being a part of client initiatives and kind of new things is really compelling. And so I think that's what we're constantly told when people join us from places that are bigger, stronger, faster, whatever, and very much trying to keep that spirit alive.
Dennis Tito, as you mentioned before, the founder of Wilshire, is a legendary figure who started out as an aerospace engineer. I'm curious what leadership lessons you learned from working with Dennis.
Dennis was an aerospace engineer and had this idea because when he was working at the Jet Propulsion Lab in the late 60s, early 70s, they had access to the most powerful computer technology. And that's really what they were using to put spacecraft into orbit. And sort of first idea, which led to Wilshire being founded in 1972, was if you could apply the power of computer technology to solve investment problems that hadn't been solved before. And the first problem that they set out to solve was, how do you measure an equity beta using software? And that really formed the basis of a lot of the early work that Wilshire did around risk and how do you apply a risk in sort of pragmatic ways? How do you help investors better measure and then ultimately manage risk? And that, frankly, those lessons about the role that technology plays and the role that innovation plays has been a hallmark of my time at Wilshire. And Dennis thought about everything in the context of risk and reward, risk and return, thought about everything in the context of a portfolio, even the way that the firm was organized in different kind of business units, with each of which had a head. And there was even degrees of competition within the firm and across divisions, was part of this view that he had about diversification and balancing risk, balancing people risk, balancing business risk. He managed that way into 2021. There was a lot of lessons along the way. There's also a lot of really incredible people over the last 50 years that have come through Wilshire's doors. And Wilshire has always attracted certain types of people, innovators, deep thinkers, and frankly, a lot of people that run very successful businesses today across the financial services landscape have come through Wilshire's doors.
So people who want to get into consulting, what do you think makes a good consultant?
I'm a big kind of liberal arts guy. And I think at the end of the day, being able to read, write, and think critically in a world where, yes, we're looking at numbers and we're looking at using statistical routines to evaluate investment performance, reading, writing, thinking are still incredibly important skills. Being curious, right? Being incredibly curious, seeking to understand the why behind why is it that a manager does, why is it that a performance is persistent, what would change that thesis, the ability to be humble enough to understand that there's a lot that is hard to understand, the ability to recognize when we get things wrong and when a core thesis is challenged by kind of new facts. I think these are among the important components of a successful consultant, manager, research professional.
In today's markets, you're observing these flows coming in. I'm interested in where you're seeing the money going based on strategy. What's hot? What are people interested in now?
Private markets, private equity, private credit continue to be the charts. There's still a healthy amount of return seeking among pension funds that have return objectives that need to be met. And that's, driving a lot of the private equity allocations. Private credit continues to be an incredibly hot asset class. We're seeing a lot more demand for infrastructure, real assets, part of that born out of inflation protection. But a lot of it is, higher yielding types of strategies. The other areas that we're seeing quite a bit is in this sort of idiosyncratic credit where, for example, asset-based loans, risk transfer strategies, IP royalty types of strategies as well that have contractual cash flows, higher yields, and or more persistent sources of income. So we're seeing quite a bit of activity there, and Wilshire's pretty active in that space too.
Jason, I want to thank you for joining us today and sharing your wonderful insights.
Thanks very much, Joe. Appreciate the time that we were able to spend together.
Thanks for listening. If you enjoyed the podcast, please leave us a review on Apple Podcasts or share it with your friends. Thank you.